gang? Welcome back to Market Talk Monday with Isaiah Porter
Come on down.
and the gang at Foundations Investment Advisors. So, market commentary
Yep.
for the week of the 5th.
Mm-hmm.
There's some pretty exciting stuff going on, but there's a lot of still the same old, same old.
Yeah. I mean, S&P closed within 50 bips of its all-time high. Russell 2000 closed at an all-time high, so small caps were performing. And then switching gears over to the entertainment kind of, not really AI, but the tech, I guess you can call Netflix kind of tech. But entertainment space, they were trying to acquire Warner Bros. And then as of Friday, I believe there was they had some notion or something happen where there was about a $72 billion debt finance. And then you just actually informed me earlier, it's not on our commentary when I send it out. But Paramount has now thrown their hat into the bid.
Yeah, there's an aggressive bid for an aggressive takeover. So
that's interesting too, because Paramount just got the UFC too.
yeah.
So they're leaving ESPN Plus and they're going over to Paramount. And I'm pretty sure the UFC fights are now going to be, if you have Paramount Plus, are now going to be streamed on there without.
This is kind of frustrating. I mean, I can't obviously speak for our clients or consumers in general, but I think the sentiment amongst most people is that, especially my age, is that years ago we got away from cable TV and the confinement, the constraints that cable TV put on you. Like, if you wanted in our region, if you wanted HBO, if you wanted Cinemax, if you wanted all of those movie channels,
you had to premium.
You pay the premium through your cable provider like Cox Communication. And they had a monopoly in that market. Now there's been this decoupling where each of those formats
they
and
found
platforms have their own streaming service.
Yeah, they found a new way to get through it all through streaming, and Netflix was kind of the arrowhead or the tip of the spear on the streaming platform.
Yeah, I mean Netflix is really the father of that.
Yeah,
they birthed the streaming world that we know today.
Well, they started it with movies for rent. They were the new Blockbuster. Yeah, the new Blockbuster, and then they had the little box you would go up to, and then it very quickly transitioned from movies to you could play video games. You could go rent video games.
Do you remember still that I'd go on Friday nights and
we'd go
to Blockbuster or go to Movie Time?
Yeah, I remember going to Blockbuster and renting GameCube games.
Yep.
From Blockbuster.
My, how times have changed in such a short period of time.
I remember me and Jacob broke a GameCube game from Blockbuster one time. And
I'm sure that had to cost me some money.
Yeah, don't drag me into this.
Yeah. I don't know how many games I've broken.
But back to the market commentary, with Netflix doing that and the kind of the bid that Paramount has, it coincides with what's going on in the AI sector too. You see a vicious cycle of these companies are kind of in cohorts together where it's like you'll have NVIDIA making a certain thing or Google, and I forget the specific companies it's happening with, but I know NVIDIA is one of them, where another tech company will come to them and they'll need an NVIDIA-powered chip to meet their certain goal. And this is kind of the space of where the AI bubble is coming from, because NVIDIA will loan these companies money so that this company over here can go back and buy the chips with NVIDIA's loan money. And it's kind of hard to track this actual spending and the actual debt levels that these companies are acquiring. And that's where that AI bubble is coming from, is because at what point is NVIDIA going to loan out some money? This company buys the chips and they're investing in the hopes that what they're making over here is going to be worth more than what they gave them over here. And at what point does that kind of pop? And that is where I think we could see the downturn or the pullback on that AI space.
It's some fuzzy math, and when you think about what they're saying it costs for AI and the power of computing, the math doesn't math sometimes. So, I think certainly there's a risk for that. What are you doing in portfolios to mitigate and minimize that there may be a bubble?
Yeah, I'm chair scooted back. I'm transitioning, and as we near the end of the year, I'm transitioning some of the clients that we have now into some inflation-sensitive models. Even though we're going to see rate cuts, people are like, well, they're not raising rates. What are you talking about inflation? Inflation's just, in fact, the weakening of the U.S. dollar.
Mm-hmm.
So if people have a fear or they have a notion that they think their dollar might be being eroded, that's where you can usually go into commodities in the commodity space in that fear kind of mindset where gold is performing, silver is performing. What was it, 2 years ago? Gold was 2,000 an ounce.
Not even 2 years ago.
And gold's performing. I think there's some sorts of speculation that if we do something with Venezuela, I think oil could become pretty profitable.
Well, we certainly should see a spike. So if the U.S. decides to do any type of military action, aka invasion of Venezuela, you certainly should see a spike in oil prices, right?
Mm-hmm.
Now, the problem, I think, in Venezuela, where you're going to get folks who are really into oil as a commodity, is that it's a dirty oil. It's supposedly harder to refine, more expensive to refine. So I think in a lot of ways, some countries will kind of buck that there should be an increase in crude oil. But to that point, there's also issues across the sea, across the Atlantic, with Russia and Ukraine. And even though there's a deal in principle, there are many who believe that that's going to fall apart.
Mm-hmm.
And then there's a whole nother piece that there are those who are speculating that Israel is not finished with Iran.
Mm.
And so if Israel's not finished with Iran, what's that going to look like?
Yeah. I mean, there's all sorts of things happening. I don't know if you've heard about a lot of our models use institutional shares from BlackRock. And BlackRock is looking to have a majority stake in C.K. Hutchinson's ports in Panama.
Yeah.
So if we do something, and the U.S. does do something in Venezuela, there is some opportunity through Central America and Panama that there is U.S. investing going on in certain ports. I think, what I'm reading right here, the deal is valued at about $22.8 billion in certain ports that BlackRock is looking at getting into, and that can open up another venture, a little bit more of, I feel like, ease of access, especially if it's American owned. So.
The key factor, Isaiah, I think, when we're having these conversations and you and the team at Foundations are thinking about all things investments, folks, is the acceptance of risk.
Mm-hmm.
So if you want to have a portfolio that's heavily laden with investments, understand that you're accepting all the risks that come along with that.
Mm-hmm.
So in our money philosophy that we've had as a firm, both on the insurance and the investment side, is to have a properly diversified portfolio that takes into consideration the risk adjustments that you have to make in a portfolio for income.
Yep.
And then we should have the transfer of risk, aka your insurance products, life insurance, annuities, specifically are those transfer when we think about it from an income point of view or from an asset protection point of view. We need to transfer a portion of our risk. And the old thought process here that's still current today is we got 3 buckets in a very simple or simplified approach. There should be a cash flow bucket, that bucket that just manages your year-by-year cash flow.
Mm-hmm.
Then there should be a protected income bucket, a bucket that will provide the cash flow to that cash bucket on an annual basis or on a monthly basis to make up that difference that Social Security and pensions is not providing you. And then the space that you live in, Isaiah, and that you're working in with our clients is the growth bucket.
Mm-hmm.
That bucket that is the acceptance of those risks.
Yep. And speaking of acceptance of risk, on the Bitcoin front, Vanguard just opened access to Bitcoin. So that's a pretty big institution and financial firm to open access to, especially a lot of 401ks or people that are used to that Vanguard platform. That opens up a lot of access to Bitcoin without being
So Vanguard's now going to custody.
Yep, it says right here,
Bitcoin.
Bitcoin underperformed other risk. This is in our commentary. Bitcoin underperformed other risk assets, but may see tailwinds as Vanguard opens access.
Interesting. Well, I think if Vanguard's headed down that path, I think it's only a matter of time before we see other
Fidelity and
custodians
Schwab
and
are hot on
Schwab,
their heels.
Pershing, Interactive Brokers. I mean, I think all of those.
I mean, they'd be silly not to.
Yeah.
It's just figuring out how to do it. I mean, the broker, they're probably, I'm guessing what's taking time is they're probably building inventory.
The other thing to remember with that is that right now, from a regulatory point of view, it's not as regulated as the rest of the equities market. So,
and there's only 21 million coin or shares, if you want to call it that. Shares or coin in the market, and that's it.
Yeah. Coin, I think, is the appropriate term.
Coin is the appropriate term,
but people think of it in shares. I guess your point being, but you got to think about, okay, you've got these institutions now opening up the coffers to be able to provide that to their investors. You have to think about, from a regulatory point of view, how's the government going to stick their hand into this plan? I just think long term, you have to plan as if this is not a decentralized asset anymore. It's going to fall under the centralized authority of the federal government, United States federal government, and probably other sovereign nations as well long term. So if your mindset is that you're really decoupling or decentralizing yourself, don't plan on that being the case long term, in my personal opinion. That's short lived. As we move through the rest of the year, which we have about 20 some days left in Isaiah, this week it's going to be big news in the market as far as rates. The advisory and the team have a probability of about 87.5% that we see
a
rates
25
cut.
point cut.
So 25 basis point cut in rates again.
And I expect to see people with the 25 basis point cut, still a little bit of a stagflation environment.
Interesting. That'll be something that we can continue to talk about as we see rolling into the first quarter of the new year, how things play out. But I think first quarter 2026 for, not that I have any inside information, but I think it'll be a very interesting first quarter to see how some of this national news plays out and some of the scuttlebutt from Venezuela to Israel. It'd be interesting to watch.
It is interesting to hear you say that Israel doesn't really feel like they're done with Iran yet.
Yeah.
It's been quiet over there for some time now. I feel like not really too much major news coming out of there, but
yeah, I again, personally, I think Israel would like to see the current Iranian regime
eradicated.
Dethroned.
Yeah.
Would be a kinder way of saying it. More to come on that.
Yeah.
We'll see if I'm right. We can always go back and
but with ending it here and kind of wrapping up everything that we've kind of gone over, that I think the recommendation is still the same of diversification in your portfolios, and that's what me and the team have been really focusing and honing in on, looking at our inflationary assets that we have, aka gold, silver, things that are gonna keep pace and not have the effects of we got to be able to, if your dollar's eroding, go somewhere where it's gonna keep up.
So are you saying to clients to be prepared to see some movement in the portfolios to reduce risk? Is that what you're saying?
I think especially like we've seen the NASDAQ had a little bit of a pullback. Our unconstrained model went from 72% to 50%, 56% for the year. I think what I'm looking at now is like, okay, 56 is still a fantastic return. Let's take some eggs, let's take some risk off the table, and then redeploy once we see the first quarter kind of play out, give it some time. And that kind of protect, like, especially if the office is closed and I don't have limited access, but if I'm not in my office looking at charts and doing everything that I need to do every day, with Christmas coming up and everything, it kind of gives us that hedge or kind of a little bit of protection. I want to make sure our clients are taken care of and that I'm not leaving them overexposed while we're having Christmas. I know the markets will be closed on Christmas, but
Well, 2019, there were 3 trading days left, and the market corrected by 22%, which left the S&P down I think it was 4.5% in 2019 in 3 trading days.
Yep.
So you saw a 25+% swing in the market in the last 3 trading days of the year, which made the year negative.
Yep.
So there's time for crappy things to happen still this year. So just diversification, diversify.
And that's not to say that we're taking everything out of the unconstrained model, but you want to be able to, let's at least go maybe back down to the principal value that we started with, because now we're seeing that, hey, you've won a little bit. I had a review of a client that joined us probably 3-4 months ago on our platform, and the account was up 33%.
Jeez.
So being able to see him kind of take those earnings and those winnings and kind of
Like taking some chips off the table if we were using a gambling analogy.
Yeah, gambling analogy. Hey, you hit table max. You've been at table max for a while now, and then you just lost your first table max hand. So let's go back to the minimum bet again.
Yeah, I like that.